Measurement of risk and return. Already we have learned in the previous sessions what is risk. Risk is nothing but a fear of loss. It is nothing but a threat which you are going to face in the course of investment. So here what happens, the outcome is not known. This is what you are going to take a risk. What is return? It is the return on investment. Whatever amount you invest, on that the return what you are going to get in the form of interest, dividend, profits, that we call it as return. Measurement, it is nothing but calculation of risk and return. Let us go for the next slide. So here we have the recap of the previous class. What did we study in the previous class? Sources of investment information. Here we studied about the international sources and national industry, company, and we spoke about stock market informations which we have to understand in order to purchase a security. We have the learning objectives of the chapter. As I have already told you, the learning objectives of the chapter will be common for all, but here we have understanding of the investment settings, alternate investment opportunities available, concepts and measurement of risk and return. We are in this concept, that is concept of measurement of risk and return. Next we will be dealing with valuation of fixed income securities and bond innovations. What are the session outcomes? Here the students will be able to measure the risk and return of an investment. Of course, we will be having some simple problems also on this. So here we have measurement of risk and return. As we have discussed, risk is nothing but a fear of loss, or it is nothing but the threat what you are going to face from the environment. Of course, in case of investment, return is nothing but the return on investment, which can be in the form of profits, interest and dividend. Generally it is in the form of dividend and interest, and of course many times it is in the form of capital accumulation. So wherein the value of that particular commodity, asset or bond or security goes on increasing. Now actually what happens is, generally risk exists in all kind of securities. It is the task of the investor to measure the risk and then go for taking an investment decision. Here, so we are going to study about the different techniques used for making investment decision or calculation of risk and. So students, I will just brief out the techniques used for measurement of risk and return. So the first one is nothing but sensitivity analysis. It is also called as what if analysis or simulation analysis. So it is a way to predict the outcome of a decision given a certain range of variables. Here a range of variables will be given, you assign probability and then you will go for calculation of sensitivity analysis. So what we do here is, we create a set of variables, and by using those variables we can determine how changes in one variable affects the outcome. Those variables, how they are going to affect the outcomes. So the next one what we are going to study is about the scenario analysis. Under scenario analysis, we analyze future events by considering alternative possible outcomes. The basic difference between sensitive analysis and scenario analysis, there we consider, in sensitivity analysis we consider a set of variables, but here we consider alternative possible outcomes in the future. It is one of the main forms of projection. It does not try to show the exact picture of the future, but instead it presents several alternative future developments which are going to take place or which are going to happen. So the next one is break-even analysis. It is nothing but a point where there is no profit, there is no loss. Actually, this break-even analysis allows a company to determine the minimum production and sales amount for a project to avoid losing money. So here what happens, you are going to calculate the risk and return. Generally what is the criteria is the return should be more than the risk. So where break even is a point where the risk and return are equal. So the anything above that break even point, whatever you get, that will be considered as a return. And if it is above the break even point, only then you have to consider that particular security, otherwise it is better to avoid it. So we have here the Hillier model. It is developed by F.S. Hillier. According to him, the risk associated with the project can be assessed through the standard deviation of expected cash flows. So here we should have cash flows, expected cash flows, we have to calculate that, and we have to calculate the standard deviation of those cash flows. So here what happens is, when you take the deviations of cash flows from mean cash flows, you will get the difference, and through that you can calculate standard deviation, and based on that you can assess the risk or return what you are going to get in the future. So we have the simulation model. What is the simulation model? It is, of course, also called as variable analysis. It is a method where the infinite calculations are made to obtain the possible outcomes and probabilities for any choice of actions. So what happens in simulation model is, you try to build a model and then try to calculate the risk or return out of that particular model. Next one, we have a decision tree analysis. The name itself tells decision tree is a systematic tree-shaped diagram used to determine a course of action or show a statistical probability. So here what we do, each branch of the decision tree represents a possible decision or occurrence. So we put it in the form of different branches and trees, and at last we will compute a particular, we go for different alternatives, and the best one will be chosen out of that particular decision options, whichever are available out of that particular decision tree. Corporate risk analysis is one of the techniques used where the focus is on the analysis of risk which influences the project in terms of the entire cash flow of the firm. And here the corporate risk of a project is nothing but the share of the total risk of a company which is there in the market, and that has to be analyzed by an investor. So it is the risk of the company. So likely you will also have the risk for the security belonging to that particular company. So the analysis is done based on that particular concept. This practical risk analysis consists of not one technique, a various group of techniques which will be used for assessment of risk. That includes margin of safety, cost figures, conservative revenue estimation, flexible investment yardsticks, and judgment on these 3-point estimates, and also acceptable overall certainty index. And students, since we have problems in this practically, so I have just briefed out the different techniques used for investment decision, because next we have to go for the problems based on standard deviation and mean of the flows, cash flows, whatever we have. So let us go for the problems now, students. So students, we have here the problems on risk and return. Concentrate clearly. I will be explaining the first problem in detail for you, and of course later on I have worked out some 4 questions. You can just go through all those and you can work out in the same way what I am going to use, so that you can understand it very easily. Now here the question: calculate the expected return and the standard deviation of return for a stock having the following probability distribution of returns. So here we have to calculate expected return, that is nothing but x bar, and we have to calculate standard deviation of the return. So let us go for that. Very clearly we will understand how it is been done. Okay students, so now they have given us the cash flows or possible returns in terms of percentage, and they also have given us the probability of occurrence of these returns. So now possible returns, what are the possible returns we have got? We have -25, -10, 0, 15, 20, 30, 35, and here we have 0 0.05, 1, 0.1, 0.1, 0.15, 0.25, 0.2 and 0.15. Generally this probability will always be a value 1, that is 100%. Let us go for working out. In this, for the first problem, what I have done problem step by step. Actually we can incorporate all the details in one table itself, but I have not done that because you should understand it clearly. So let us go for the question. Okay students, have you seen? So students, we have just taken the values which were given in the question. From there we have just carried forward the values, and here we have to calculate first the expected return. The expected return will be calculated by multiplying R into P. Very simple calculation. And dear students, and first understand one thing, these are very simple problems. You have already studied QMB in your first and second sem, so this will be very easy for you. So first we'll multiply P and R. Minus 25 into 0.05 is minus 1.25. Minus 1 into 0.10 is minus 1. 0 into anything is 0. So here we have 0 into 0.10 is 0. 15 into 0.15 is 2.25. Like that we calculate for all the values, and summation P into R is 16.25%. This is the return, expected return what we have calculated. A very simple calculation by multiplying R into P. Got it students? So here as I told you, first one is minus 25 into 0.05. So how much we get? Minus 1.25. Likewise we calculate for all the other values and get a sum of 16.25. This is the total of this column. Add all the positive values, deduct the negative value, you will get 16.25. Let us go for the next step. So again what I have done, I have carried forward the details from the previous slide and from the main question. We have possible returns here, and we have the probability as given in the question itself. Okay students, and in the previous table we have calculated the expected return, that is 16.25. So now what we are going to do, we are going to take the deviation. How we take the deviation? We take R, that is possible returns, minus R bar. R bar is nothing but the expected return what we have calculated in the previous slide, that is 16.25. So when we take this, see, we take minus 25 and minus 16.25. We are going to deduct from this minus 16.25. So at the time what happens, minus will be minus itself, minus plus minus is minus. Okay, so when we add this, it will become 41.25. So the sign remains same because we are adding. When we multiply, minus into minus will become plus. When we add minus plus minus will be minus itself. So we have minus 41.25. Same thing happens here. Minus 10 minus 16.25, you will be getting minus 26.25. 0 minus 16.25 will be minus 16.25 itself. 15 minus 16.25 will be minus 1.25. 20 minus 16.25 will be 3.75. 30 minus 16.25 will be 13.75. 35 minus 0.15 will be 18.75. The next one is deviation squared. Whatever deviation we have taken here, we are going to square it here. It means here we are going to multiply minus 41.25 with minus 41.25. So you will get 1701.56. So do this for all the variables, all the values. So you will get summation R minus R bar. Okay, but we need not take this total, but only we have to multiply. The next one is product. How we take the product? R minus R bar, that is this column. Okay, that is fourth column, and the probability column, that is here we have the probability column. You have to multiply. When you multiply these two columns, you will get product. that is 85.08, that is 1701.56 into 0.05, you will get 85.08. Likewise, do it for all the values. You will get the sum of r minus r bar into p, 274.69. So we apply the formula. Standard deviation is equal to square root of 274.69 is equal to 16.57. This is the answer what we have got. The expected return is how much? 16.25, and here the standard deviation return is 16.57%. So here students, follow the same way what I have done, and then you will be getting the answer. They have asked us to calculate the expected return and the standard deviation of the return whatever we have got. So next I will go for the next question. I think that you have to work. So here we have the next question. Mr. Leo invested in equity shares of Wipro Limited. Its anticipated returns and associated probabilities are given below. So here we have possible returns. It is given in terms of percentage, probability given in terms of fractions, and as I told you, the total of probability will always be 1. Let us go for the calculation now for the next slide. Students, we have here the table. I have incorporated all the details in one particular table. Last problem I prepared 2 tables, but here I have prepared only one table and put everything into it. So possible return is represented by R, probability by P. When you put P into R, you will get the expected return. And when you take the deviation, that is R minus R bar, R is here, that is values given in the question. R bar we have calculated. When you take the difference, you will get the deviation. When you square this deviation, you will get the value for R minus R bar. So what you are going to do, you are going to square this, that is 5 minus 5.5 into minus 5.5, and then multiply this R minus R into P, that is the probability. You will get the sum of R minus R bar into P. Apply the formula. Standard deviation is equal to square root of this sum, 45.75. You will get 6.764 as the answer. So students, we have the next question. The probabilities that associated returns of Fiber Foods Limited are given below. This is very similar to the next previous question. Returns are in the given form of percentage. Probability is given, and as for the previous slide, I have prepared one single table and I have calculated everything, and just work out this problem in the similar way what I have done, students. You will be able to understand it better. One more question on this. The probabilities and associated returns of security X is given below. They have given us the return and the probability. Again the same table, incorporate all the details and calculate it in the same way what I have done. Okay students, you will get the answer as 4.04. So now we have the multiple choice questions. Financial disclosure regulations affecting the brokerage industry are a type of market risk, financial risk, business risk, liquidity risk. The answer is business risk. So the next multiple choice question is, the statistical tool used to measure a company risk is mean, mode, variable, covariance. Covariance. So standard deviation squared is actually covariance. Which of the following is true regarding the expected return of a portfolio? It is a weighted average. It can only be a positive. It can never be above the highest individual return. All of the above. It is all of the above. So here students, market risk is best measured by the same question asked in a different way. Alpha, beta, standard deviation, coefficient of variation. The answer is coefficient of variation. So we have the last sub question in this session. Total return is equal to capital gain plus price change, yield plus income, capital gain minus loss, yield plus price change. It is capital gain plus price change. So here we have the references, students. You can just go through this, and I'll see you in the next session.